Yeah, we can definitely go. Want to make sure that we keep things on schedule today for people. And so, yeah, we can definitely get started. Thank you, everyone, for attending today's presentation for loan denials and strategies and that you can do mitigations for those loan denials. My name's Vince Hayworth. I'm the director of the Capital Access Center, and I work for the SBDC system, and specifically here in Kansas. So thank you for joining us. Today we've got a really great presentation. I think everyone on board is going to really enjoy seeing some of the common reasons for loan denials and strategies that you can do to overcome those. I've been just a little bit about myself. I've been a banker for 20 plus years. I worked in SBA lending for the last 8 years, so I can confidently tell you I've seen a lot of these and give you some insight for those. And one of the things about this training I would really encourage is we have a chat room available, so please feel free to ask questions during the training. We can certainly stop and answer those for you. And please feel free. I mean, this is an open forum. We really want you to be able to ask questions. A lot of times we're gonna we'll talk a little bit more in depth, but not oftentimes banks are, unfortunately, there's a lot of compliance involved, and sometimes with denials you only get basic denial reasons and not real in-depth reasons. So there's a lot of questions about why my loan was denied. And so I want everyone on board to feel comfortable to ask those questions, see what we can do to help you, because ultimately at the end of the day, we really want to make sure that you try to get the funding that you need for your business. So with that being said, we're going to go ahead and get started. So financing is often one of the biggest obstacles for a business. You think about starting your business and the planning and execution and everything that goes into it. But if you don't have the financing in place, the reality is that your business isn't going to get off the ground. So and getting bank financing is a key component in that. You can have the best plan in the world, but if you don't have the capital to get started, you're going to keep that on paper the whole time. And I really want to stress with this training, every client and circumstance is different. We're going to try to focus on the most common ones. There are so many different reasons that could happen for a loan denial. And we're going to really try to focus on the top reasons. If you need more in depth, we're going to be able to answer questions at the end. My contact information will be there. We can certainly help you offline too. As I mentioned, just multiple reasons why a loan can be denied, unfortunately. So, and some of the things that you can do to prepare. So this is really a good self-test for your business. Some of the things that we're going to cover in here today are things that it would be really good to ask yourself as a business owner or potential business owner. Can I hit these metrics when I'm looking for a business loan? And shameless plug here, the Capital Access Center and the SBDC, we're well equipped to help you through this process. We help thousands of clients statewide and nationwide. We just have a footprint all over the US, and we help clients just like yourself all the time. So evaluating your loan requests, when you approach a bank and a banker, they're going to look at your request and they're going to ask these 5 things of every loan request. And we're going to do this. This is a really good self-test. If you're a business in the audience right now, I would ask you, think about these 5 things that we're going to talk about, and can you deliver on this? Because this will be a really key component to you getting your business loan approved. So first of all, capacity. How will you repay your loan? At the end of the day, the bank may like you and they may like the business, but ultimately all they care about is getting paid back. So really, you need to ask yourself that question. Are you going to rely just on the business cash flow to repay this loan? Or do you have outside income to help pay for this? We're going to talk a little bit about some of those strategies you can do, but that's ultimately one of the biggest things that you need to ask yourself. If the business cannot pay for my loan, how else am I going to be able to repay this loan back? Capital. How much will you invest equity into this particular loan? In 2008, with all the loans that went bad, unfortunately, a lot of these people did not have a lot of equity into their loan. So it was real easy for them to walk away because they didn't really feel any pain. In today's world, the lenders really want to see that the borrower and the guarantors have skin in the game. So we're going to talk a little bit more about that later too. Conditions. What is the economic climate and within your particular industry? Right now you think about everything that's going on. We all know that we're in a pandemic right now. Things are looking better, but we're still on the cusp of a pandemic. So conditions can vary quite a bit within industries. We've got some that are performing extremely well because of the pandemic. And as everybody knows, and if you watch the news, we have some that are struggling quite a bit. Hopefully better times are around the corner, but this is something that you may want to ask yourself. Character. What are your qualifications and credit history? We're going to talk about this over and over today. One of the biggest things that the lenders are looking for today is, do you have experience in your industry? As a lender, I used to get people come in all the time and they always wanted to open up a coffee shop. And my first question would be, what kind of experience do you have in the coffee shop industry? Well, I go to coffee shops. Starbucks always looks like they have a line. It'd probably be a really good business to make money in. My next thing, I would go make sure you get some experience within that industry. It's really, really important that you have that. We're going to talk about your personal credit history. Until your business has an established business credit history, they're going to look at your personal credit as part of that equation. So we're going to dig a little bit deeper into that part. And then collateral. What assets will you pledge for a loan? Again, the bank wants to make sure that they get paid back for their loan. So collateral can be a big factor in whether or not your loan gets approved. So here's my top 6 reasons for loan denials. This can vary with every bank and situations can be different. But by and large, these are the main reasons why business loans are denied. So the first one we're going to talk about is an ability to repay proposed loan based on current business and personal cash flow. We're going to get a little bit more deeper into these details in mitigants and strategies later, but this is probably the number one reason why businesses are not loaned money. Startups. These are always the toughest loans to do for banks because the risks are a lot greater for this particular part. There's no proven cash flow history. So that's one of the things that you really have to look at is how you can mitigate these kind of strategies. There are some things that you can do. Banks are going to consider a business a startup, especially in the first 2 years of business. So they really prefer to see at least 3 years of full tax returns and before they consider a business not in that startup phase. Low cash reserves. I think if the pandemic has taught us anything, having cash on hand is probably one of the most important things that you can do. We're going to talk about some strategies that you can do as for existing business owners and on the personal side. Insufficient equity from the business or borrower. We're also going to talk about strategies about that. A lot of times you'll see you have someone within the industry that's really good, but maybe they just don't have the sufficient equity to put into a new money request. Limited personal capacity kind of piggybacks on that same part of it. Maybe you're the main person, you're the industry expert, but unfortunately maybe you don't have all the cash that you need to put into it or the personal savings. So we're going to talk about some strategies for that as well. And then insufficient collateral, as we kind of talked about it on the previous screen. Banks really they really value this piece, We're going to talk more about it, but collateral can be a big factor in whether or not your loan gets approved. So this is especially tough for businesses that what I would consider service-based industries that may not have collateral, or the type of collateral that they have may be deemed insufficient for a bank. Moving on. Mindy, do we have a question in the chat box, I think?
We do have a question. It seems like someone's wanting to know if there's possibly a reason that banks might cut off entrepreneurs from funding Bitcoin mining businesses.
Oh, wow. Okay, well, that's a really good question. I wasn't expecting, to be honest with you. I think that, banks are inherently risk adverse. There's a reason why you see the UMBs of the world and the Commerce Banks of the world and Bank of Americas of the world be around for so long. They typically are not the first financing entity in the game. So they're going to let things play out, and they want to see history. I think I can't speak specifically. I'd have to know more about the situation, but I can tell you as a banker, if I heard that in my previous life, I would be a little bit cautious, because you have to remember that these banks they're all about reducing risk. And I think there's a lot of questions within that segment right now. It's can be a little unstable. And I think we've seen that. So that gets bankers nervous. And they're very risk adverse. But that's a great question. And it'll be interesting to see how things play out. I don't know if it completely answered it, but I think it's going to be a hard uphill battle with that particular segment. That's a great question, though.
Thank you.
We could talk a little bit more offline too. If the person who asked that question, I'd be more than happy to get more specifics. But for the purpose of this training, we'll probably have to move on a little bit on that. But appreciate that question. Other common reasons for loan denials could be industry experience, as you heard with my coffee shop scenario. That's a real scenario. People see a business and they think it would be fun, or you see that in the bar industry and restaurants, and it's pretty exciting industry, but they don't have any experience, and those are tough businesses to run. There's a lot of cost controlling in there that needs to be done, and if you don't have that experience, that can be an issue. Economic conditions, we talked about that just a little bit earlier. Think about the pandemic right now. Again, we've got some businesses that are flourishing right now because of the pandemic, but we've got some that are really struggling, and will probably continue to do so until we see more improvement in the pandemic. Believe it or not, your relationship with the bank can really be a positive for a particular business. So we're going to go into more details about this, because it's really an important factor. And if anything, this past year, it's really shown that, especially with PPP, businesses that didn't get funding with that typically were working with banks that they didn't have relationships with, or they didn't have their financials completely ready. And banks value relationships. So they're going to look at their internal customers first. So it's really important to have relationships established with banks. It's something that people don't really think about until it's too late. No previous business ownership experience. We're going to talk a little bit about that on some ways that you can mitigate that later. But that can play a factor in not being able to get a loan due to not having that particular experience. There are some things that you can do, and we're going to talk a little bit more about that. Personal credit. We're also going to talk a little bit more about that, but as I mentioned earlier, having personal credit is really important, and having low debt is really important when you're looking to borrow money for your business. Collateral is not deemed valuable. As I mentioned earlier, I think about, unfortunately, I'm going to pick on the restaurants here, but the default rates on restaurants are pretty high, especially if you think about this past year. Um, you know, collateral for a restaurant is ovens and coolers and freezers. And typically what happens with that is they go to auction. And so in this particular scenario, the particular equipment's going for pennies on the dollar. So a bank's going to look at that and they're just going to discount that particular type of collateral. So sometimes when you're in a certain industry, that collateral can be deemed not valuable to a bank because they don't feel like they're going to get their monies back. And remember, at the end of the day, that's all the bank really cares about is getting paid back. Timing. I think about where we sit today. We've got a pandemic we're sitting in, but the other thing is we're in July, right? Think about July for you personally. People are taking vacations. Well, guess what? Bankers are taking vacations this time of the year too. So timing can play into it. The end of the SBA fiscal year is in September. So a lot of people take vacations this time of the year because they know the last 2 months are going to be crazy. And you think about, if you're working with a bank and they have 20 other loans and they're trying to get funded before SBA fiscal year, where do you stand in that? So that's another consideration that you have to take into. Incomplete loan packages. This happens a lot. A banker in a bank always wants to see a complete loan package. More often than not, they'll give you a list of items that they want to see. And it's up to the client to be able to come back to that bank with a full package available. You'd be surprised at how often this doesn't happen. A banker doesn't want to keep going back and forth with a borrower to get additional information if they've sent out a needs list. So it's really up to the client to make sure that they provide that. Because guess what? The banker's going to go with the client who has everything prepared over someone who they have to keep going back to and ask for additional information. Personal character. This does come into play. I've had it happen many times where, let's face it, folks, sometimes bad things happen to good people. And it can come back to you. I had a situation where I had a person that stole a golf cart in college. You don't think about that, and they got a record for it. Now they had probation, they did their time, and we were able to clear them, but little things like that can happen. Typically, if it's nonviolent, you'll be able to overcome those type of things, especially if you've shown your character in the years since that happened. And that's where, a relationship with your banker can come into big play, where they can stand up for you and say, okay, a mistake was happened, especially when you think about when you're younger. I mean, I think about some of the things, you don't always make those great decisions when you're younger, but it's how you've overcome those and you've shown your history since then. Believe it or not, extreme growth and over leverage actually kind of go hand in hand. And this will actually play into a loan decision at times. I think sometimes you can look here in Kansas City, we're statewide here, but you can think about your hometowns and you think about businesses that you've watched from afar, and they've grown overnight to all these locations. Well, that makes a banker really nervous because guess what? How are they financing those additional locations? Are they going through cash? They're not saving cash. All of a sudden, before you know it, they're over leveraged. So this will really get a banker nervous. Mindy, do we have some more questions in the questions and answers?
No, that was the Bitcoin one was the main question.
Oh, okay. I thought I saw a couple more pop up. So, okay. X factors. Believe it or not, these two boxes at the top can really make a decision can really impact whether or not your loan gets approved. It's a simple one, But I'll tell you what, you would be surprised at how often we hear stories about people that go to 15 different banks and they get denied all the time. Well, everybody that's on this call, think about your biggest city or town that's close to you. And if you think about the banking institutions that are in those particular locations, there's multiple, right? And you always probably wonder, well, what's the difference between ABC Bank and XYZ Bank? Well, guess what? They all do something different. You may have ABC Bank that only specializes in real estate loans. So if you're a retail operation and you go into this particular bank, then you're probably not going to get very far. That's what they specialize in. They may have a lender that specializes in manufacturing. So it's really important to find the right bank for what you do, because they all have to get comfortable with your particular industry. And a lot of people don't understand that part. As a consumer before I got into banking, I wouldn't know that. But it's really important as a business owner or potential business owner that you interview those banks to see if they even like your industry. And then picking back on that is the lender. All lenders are not created equal. I can tell you that. There is no substitute for experience. Because you're probably wondering, well, what's the difference? Well, it kind of goes down to how the credit decision is made. So most often than not, most banks make credit decisions by loan committee. And a loan committee is made up of a chief credit officer, a bank president, a vice president, and you have fellow lenders and board directors that sit around a table who don't know who you are. And guess what? It's the job of the lender to go in, present your business and your opportunity to them. So if the lender doesn't understand the industry, doesn't understand the request, and is not passionate about your business, what do you think your loan chances are at that point? It can really be affected. I almost felt like I was a trial lawyer when I was a banker and I was presenting to committee, because you really had to present your case and had to be thorough. You had to be convincing that they should take the depositor's money and loan it to you. So it can make a big, big difference. Having mentors and partners can really be a huge mitigant for some weaknesses that you may have. So you think about mentors, we talked about previous business ownership. Well, if you've never been a business owner, but you're lucky enough to know someone who has been, or you can take classes. I think about Kaufman and Fast Track and things that you can do to show that you're prepared. A lot of times an owner, if you've been working with them, you're a key employee for 20 years, take on additional responsibilities, show that you're able to run that business. And if you want to strike out on your own, ask them to be mentors when you strike out on your own. We see this a lot in breweries, and I've seen it in barbecue places. People are willing to help. And partners, I think about some of the industries that I've lent to, they're really good at what they do. But maybe they need some help on the financial side. So bringing in partners such as accountants and attorneys, people like the KSBDC, that can help you, guide you through your business on that part of it, because the operational side is just as important as the front end of your business. Mindy, do we have some questions in the chat box?
We do have a couple questions. The first question is, should you start with your personal bank first?
Great question. Yeah, I think that's a great place to start. But I will caution you, though, because your personal bank may not be the right bank for you, though. Because a lot of times, I grew up, I banked where my parents banked, because that's what you do. But I would really particularly talk to that bank let them know what you're doing, and see if they're on board with it from long-term continuity. Because if not, then it might be worth looking at a different bank. If you're, I tend to talk about restaurants a lot because we see this, but if the bank's never going to make a loan to a restaurant, and most often than not, they'll say, well, we don't know, we haven't really made a lot of those kind of loans before. They particularly don't like to say they won't do it because they really can't. But you can also look at their history too and see if they've done it. But I think starting with your personal bank is a great way to go, especially if you have a relationship there, because we're going to talk a little bit more about that, and you'll see where there's some advantages. So, great question.
And this next question seems to be a little bit of a follow-up from a different attendee. So what if you do have a good relationship with your bank, you feel you've done everything right, and you still get denied?
Time to move on. So unfortunately, like as I just mentioned, it may not have anything to do with you or your business. It may be the comfort level of the bank. I can tell you, especially on the local, maybe on the regional and local level, I've worked for all different levels of banks, and you may have a chief credit officer that took a loss on a loan in your particular industry 15 years ago, and they vowed to never take one again. They're never going to bank that type of business because they had a horrible experience. So it may be a simple matter of you're just not a really good fit for that particular bank. So unfortunately, if they've denied you, there's no reason to really stay there. You really should look at a different opportunity. And the bank probably would agree, they, on the personal side, they really don't want to lose accounts, but if they're not going to work with you on the business side, then I highly suggest moving to looking for a different financial institution that can help you. Great question.
Thank you.
So, we talked about the reasons, but how do you overcome them? And we're going to give you some strategies here. Again, this isn't a complete list. There's so many different reasons why things can happen. And there's multiple of ways that you can do it, but these are some of the most common ways that you can mitigate loan denials, look at maybe some strategies to overcome those. So as you can remember, the very first reason was the inability to repay the proposed loan based on current business or personal cash flow. So one of the things that I used to do as a lender is look at it and go, if you were in business, did you have any one-time expenses? That was always one of the very first thing. If you're a current business owner and you had an HVAC system and you had to replace a roof last year, and it took $70,000 to do both those items, and your CPA told you to take that off of your business tax returns so it can reduce your tax liability. But when you look at the net income numbers, all of a sudden the banker's like, well, that doesn't look really good. I don't think it can pay back the proposed loan based on historical cash flow. Well, that's one thing that they can take into consideration is we know that they aren't going to have to replace the roof and HVAC again. So those are common things that they can put back into the net income to help the cash flow numbers. Did your business have an extreme situation that was unusual? I don't think we can use COVID as an extreme or unusual situation because there's so many different businesses. Everybody's been affected by it. But in past years, I had a business whose shipments there got seized by customs overseas. Well, they'd been in business 15 years. They always had great cash flow, but the particular year before that, this happened. It caused the revenues to plummet. So when you looked at it, you were like, well, what happened here? What was the situation? And so we were able to go in and explain that. And it was a one-time thing. It was a fluke. They had no reason to seize that particular shipment. But it was kind of an unusual situation. So those are some things that think about that in your business. If you're an existing bank, was there something unusual that caused this to happen? Is the bank just looking at the business cash flow? A lot of times they can, what they'll do is they'll look at personal and business, and this is called business, this is called global cash flow. And a lot of times what you'll see is maybe a spouse will have a good income where it can offset any kind of discrepancies within the business. So maybe the business is doing okay, maybe it's a startup, so it's building, but the business, but the bank wants to see that it still has an ability to make the loan payments. So a lot of times this additional cash flow can be a consideration in getting a loan approved. Ask for a little bit less. You know, do you need all these top tier things that you're asking for? You know, can we cut corners without making the business suffer? You know, do we really need granite, you know, tops? Do we really need this? Do we need the top end fixtures? Is there ways that we can lower the loan amount? So instead of asking for 500,000, maybe we can look at 400,000, and then all of a sudden the cash flow works based on that lower loan amount. Look for lower rates and longer amortizations. Typically with a conventional loan, you're looking at a 5-year payback. With SBA lending, you can go 10 years. So think about that when it comes to your loan payments. In SBA, you can double that. Plus, in a lot of the cases, you do not have prepayment penalties. So having that extra lower payment can really make a difference when it comes to being able to repay that loan. Right now, SBA rates are around 5.5% to 6.5%, which is a terrific rate. But maybe you were looking at SBA and you don't need 10 years and you can go 3-4 years. Maybe you can get a lower rate. There's a lot of different rates out there that are in the 4s right now. So those are things that you can do to take into consideration. Startups, no or insufficient cash flow history. This is one of the toughest things you see. Using projections with strong assumptions. For those of you on the call who maybe don't know what assumptions mean, but basically, how did you come up with those numbers? What kind of data did you provide to back up those projections? Projection-based loans are the toughest loans for a bank to do because at the end of the day, there's no history. What we already know about bankers is they do not like risk. So they want hard facts. So the more that you can put into these projections and back it up with facts, it's really going to increase your ability to get a loan. It kind of goes with the lean on available data within your industry. There's so much data available. You can look at, you know, demographics, you know, income levels, you know, traffic counts of the particular area that you're in, anything that you can do to document how you think those projections are going to play out. A lot of times, if you're looking at franchises, they will give you the data for that area. A lot of times they won't even let you open up a franchise if they don't feel like the business can't make it based on the data that they've gathered. Guarantor support. Again, as I mentioned earlier, a lot of times, you know, the particular owner of the business may not have the particular strength to solidify a business cash flow. So a lot of times though, maybe you have a partner or a guarantor that can add that personal cash flow into the equation. So the bankers are actually call this the money person. This happens a lot. You may have a startup business where, you know, you have an industry experience, but they capacity wise, it's hard for them. So they bring in what they call a money person. And there's strategies that you can do to exit that money person, but that might be something that you might have to look into. Bank relationships or business history. One of the questions was, how important is it? Should I look at my personal bank? I think it's very important. The last thing you want to do is go to a bank when you need the money. It's always really important to have that relationship established. I think about the community and local banks especially. Um, they want to know who they're doing business with. And, you know, you may have a situation where you have a startup business. You know, Susie had a business 10 years ago. Now she's coming to us and she wants to open up a restaurant. Well, okay, so maybe we're not thrilled about the restaurant, you know, but Susie's got business experience. You know, she had that flower shop or she had that tech company 10 years ago and they did extremely well and she sold it. So that can play into an equation as well. Low cash reserves. Is there collateral or inventory that can be liquidated in this situation? You know, you think about your business. So, you know, do you have assets that are sitting around that you can liquidate? The bank wants to see that you have cash reserves to hit to make loan payments in times that where revenues might dip, especially when you think about seasonal businesses. And of course, this past year is a prime example of that. Cutting expenses. This goes for personal and business. A lot of times we'll see, you know, business owners, they, you know, doing really well, you know, and they have to have that new boat, you know, they have to have that new jet ski. Cutting those expenses and keeping them lean and mean are really important. The bankers really like to see that. For the businesses, do we need to really add on to the building? Can we make do for another year? Look at areas, you know, can we buy in bulk and get, you know, group pricing? Things that you can do. Look at insurance, you know, have we shopped out our insurance coverages? You know, things of that. Look at cutting expenses for your business. Reduce spending and inventory. We just kind of talked about that a little bit. You know, that's really a key thing. Building up those cash reserves is really important. The bankers really like to see cash both on the personal side in your savings account, and they also want to see it on the business side. And I know that's difficult a lot of times. You're probably sitting there going, well, I'm just not blessed to have an abundance of cash. And a lot of times that's where you have to get creative. You have to look at those bringing money people in, looking at loan programs that, you know, can look past some of those things. There is some options out there for you. And savings and retirement funds, you know, saving for a rainy day. You know, we hear about that all the time. I would really caution about retirement funds. You know, there are some programs out there to start up businesses with your retirement funds, but you are really making a life-altering decision when you go that route. It's not to be taken lightly, but there are options out there for you too. If you need to liquidate, you know, stocks, you know, they're pretty easily liquidated, you know, things of that nature. And then just look at slower growth and conserving cash. We see it so often, you know, businesses want to expand and they want to grow and they want to grow, but having that cash on hand is really important. Bankers really want to see cash in the bank. So here we go for the continued part of that. Insufficient equity from the business or borrower. Strategies and mitigants that you can do. Look for state, city, and federal programs. There's a lot of them out there, folks. Seeing how when I joined the SBDC last year, I was surprised at how many different loan programs there are outside of your traditional financing. Now, it doesn't mean that they're just going to give you money. You really have to work at it. You have to have good plans. But these cities and states, they're really looking at trying to build businesses up. Now, your local resources here can help you find those. They're not easily found, but you know, you look at some of the centers around the state of Kansas that can help you with that, you know, to help guide you and get you into those programs. They can really do loan matching equity programs. There's ones that We'll even give, there's programs out there with little to money down. Those are lower loan amounts, but they're out there. So you just have to be able to contact the right people and see what we can do. As I mentioned earlier, consider adding a money person. Easier said than done. But I think about some of the breweries in the area. You know, it's kind of cool for people to say that they're in a brewery, they're a part owner. You know, you'd be surprised at how often maybe people might want to invest into a particular business because it's got some cachet, or you know, maybe they see an opportunity to grow their portfolio. So you know, put the word out, see what you can find, see if there's somebody out there willing to take a chance on you. Again, lower your loan amount. You know, so if you're asking for $100,000, most startups are going to be required to bring in 20% of their own money. So maybe you don't have 20%, and you don't have $20,000 in this particular scenario. But, you know, maybe if you lower it to 75,000, you know, you have 15,000 that you can put in. So all of a sudden you're at the mark that you need to be. Your bank relationship can play into this. SBA says that you can put in a minimum of 10% down. Well, banks' credit policies override SBA policies. So when you, just because the SBA says you can put in 10%, ultimately it's the bank doing a loan. So they can say, no, we want 20%, we want 30% based on the risk that they see. But if you have a good relationship with your bank, maybe they'd be willing to work with you. You know, we've known Susie for 15 years. You know, she's been a good, loyal customer with us, and we know that she can do this. Okay, so maybe she doesn't have 20% to put down. Maybe we could do 15% as a compromise. Crowdfunding, startup engines, angel investors. You see more and more startup engine. I mean, you see these sites where they can go in, pay, raise capital for these businesses. I've actually participated in some of these myself, and they can be considered equity. And it shows that there's a market out there. I've actually banked a couple of clients who started this way. So that can be, especially for items that maybe are kind of maybe a little bit non-traditional, but it does happen. Limited personal capacity. A lot of times this is really just hard and difficult for people, but again, consider adding a partner. Do you know friends or family or somebody that can help you with this part? You know, they know that you're a good person. They know you know the industry and you're going to be a great, you know, finding that person that can add in that particular part of it can be a really big help. I will say, if you bring in those type of people, make sure you have a good exit strategy. The bankers are going to want to see that you have that. Oh, and by the way, they want to make sure they get paid back first. So if you do bring on those type of people, you have to make it clear that the bank's going to get paid back first. And your investors have to understand that too, because they're the ones taking the majority of the risk. Owner financing. This actually happens sometimes more often than you know. You just don't hear about it often because maybe you have a key person and you have an industry that, well, it's kind of hard to find that person who understands it, and you know the owner wants to sell, and maybe it's a difficult business to finance. So maybe there's an opportunity to put something on contract with that particular person. And then maybe you can finance it after 3 years when you've shown that you've ran that business. So if it's an existing business you're looking at, that might be something that you might want to consider. Insufficient collateral. As we mentioned a couple of different times, this actually happens quite a bit. One of the first things you can do is look at SBA financing. There's a guarantee associated with SBA financing. And a lot of times this gets a bank comfortable with this particular type of business because they look at it this way. After liquidation of collateral, or if they don't have any collateral, if they've done everything right, they can go back to the SBA and request the remainder of what's left on their loan. Depending on the loan program and the guarantees, they can get their money back. Now, this isn't a reason for every bank to do every loan, because there's a lot of particulars that go into it. Namely is, what do we know about the government? They do not like to give money back. So if the bank is going back too often asking for money back from guarantees, they're going to get their preferred status taken back. So it's not something they can rely on, and a reason why they should do every loan. But this could be a really good mitigant for especially those service businesses that may have collateral that's not deemed sufficient, or they don't have any. Especially you think about tech companies and things of that nature, where, you know, electronics and computers, their value decline very rapidly. You know, personal assets that can be pledged. You have savings accounts, certificates of deposits. You know, you can utilize retirement funds to start up a business. You can't use it as collateral, but you can use 401k plans to start up a business. Personal residences, these happen a lot. Bank really likes to see personal residences pledged as collateral, because they know that you're going to do everything you can not to lose your home first. So this is one of the prime pieces of collateral that a bank will ask for. And as a business owner, you have to be willing to look at that, because if you're not willing to pledge your personal residence, then that's going to send some question marks to the bank. Stocks, that can be a great collateral. You know, I think, you know, when you think about this kind of thing, you just have to be careful, though, of what you're pledging, and know that if things don't work out with your business, that there's a good possibility you may not get these items, and you may end up losing them. So you have to be careful of what you do. But you also have to be willing, if you're going to take a chance that the bank's going to take a chance, then you also have to make some chances too. Look for financing resources that work with similar industries. You know, my scenario about the banks and the bankers, you know, they all typically have something that they do really well. So if you're a manufacturing company, you know, look at, you know, what bank's done this? Do they understand my industry? You know, there's, you know, a few banks that have done breweries. You know, you think about those particular industries, you know, do they understand it, and are they comfortable with that particular business model? Okay, moving on. Here's some of your credit basics that we're going to, so everybody asked me, so what's a good credit score? Over 680 is a requirement for most banks. Obviously, the higher that you get, the better. This shows good character. There's exceptions. I mean, let's face it. I took advantage of a promo on one of my credit cards, and I check my personal credit pretty much weekly. And because I maxed out my particular card to take advantage of a 0% financing, my score dropped 30 points. I couldn't believe it. My jaw hit the ground. So be aware of your personal credit and how that can affect your chances. Again, I'm going to really harp on the industry experience. It's really important, folks, to get that experience within that business that you want to do. History of the business, you know, if you don't, look at franchises. These are a great way to go. They're turnkey. If you have the money to get into it, people are always trying to invest in franchises. I took a school teacher and put her into a Firehouse Subs. You want to talk about a 180. But the great thing about franchises is that there's a model there. It's turnkey. So if you have skills that can relate to this, franchises can be a great way to go. Banks also like franchises because there's established processes and history in place. Having secondary source of repayment when you look at your loan requests, this is a big deal for loans. You know, for banks, you think about this past year, you know, where business revenues have dipped. You know, the ones that had an ability to make up those payments and have that secondary source of repayment is a really nice extra. It can really help. Keep your debt, your personal debt, as minimal as possible. These can be deal killers, folks. People, are out there, they have to have all the latest stuff, and their personal debt to income is too high. This can affect an ability for a business to get a loan. No violent criminal history. Again, there's exceptions that can be made there. That's a situation where you really you have to look at it, see what you can do about it, and how you've handled it since then. Historical verified numbers. The bankers really will continue to hammer on this part. You really have to have that part of it, or work with projections that have very strong assumptions associated with it. Again, having your financial package complete, ready to go. People talk about business plans all the time. I get this question all the time. How long should my business plan be? I always tell them, there's no magic formula, but you have to be able to talk about and explain everything about your business where there's no questions from the lender or the underwriters. If you can do that in 8 pages, good for you. If it takes 20, then that's what it takes. But you really have to have a full financial package ready to go. Be willing to pledge the assets, as we talked about earlier. If you're not willing to pledge those assets, then the bank's going to get nervous about that, and they're going to wonder why. It's a big decision, so you really have to come to that part of it and say, am I willing to do these things? And bring in equity to the loan request. Again, the banks want to see that you have skin in the game as well. So at this time, I am going to open it up for questions. I think we're right at the top of the hour, if I recall. So, Mindy, I think we have a couple of minutes, right?
Yes, we have 8 minutes.
Okay, I knew it was somewhere in there. And so I'll leave it open for some questions that may be sitting out there. We've had some pretty good ones throughout the course.
I'm not currently seeing any more than the questions we've already had so far. Oh, wait, something just popped up.
Okay.
Someone wants to know if they're going to receive the slides of the presentation.
Yeah, we can definitely get those out to you. Mindy, I'm not sure how it's delivered back out, but I'm pretty sure we can get those to you.
Yeah, I can send it out in an email along with the copy of the recording.
Okay. I really hope that this training's been helpful for people. Again, I really want to stress that every situation is different. And these are just some of the highlights. And we only had an hour today. You can see we were bumping right up against that. The SBDC and I think about SCORE and Kauffman and all these great resources within Kansas City that can, and throughout the state of Kansas, that can help you. We've got SBDC centers and throughout the state of Kansas that can help. And so I want to encourage that if you have additional questions, we're more than happy to help. Did we have another question pop up here, Mindy?
Yes, someone wants to know about using credit cards to finance a new business.
Yeah, that does happen. I don't suggest it, because, the high interest rates that are involved. But I can tell you that there are some businesses out there that have done it. And some of them use it as an expansion tool too. I don't suggest it because of just the high rates that are typically involved with a credit card. I've seen where, they've used their credit card and then they got a balance transfer for 0%. And, then they're doing the shuffling game. the reality is sometimes that's all you can get. But you know, I would say that you should always explore all opportunities before going that route. But it has happened, but I will tell you it sounds like it may be personal credit. Well, that's really going to hurt you from a long-term standpoint because, you know, they're going to want to know why. And there's a lot of reasons, but it does happen sometimes. And you know, sometimes you have to bootstrap and do what you can. But I would certainly say that's probably one of the last resorts that you want to do, if at all possible. But you can, you know. Good question. I will go ahead and my contact information is right there on the screen. So usually the best way to reach me is by email. Again, I want to thank everybody that was on today, and I hope that this was a good training for you and informative. And we appreciate your time at the KSBDC and the Capital Access Center.
Thank you, Vince.
Thank you, Mindy.